How to read a balance sheet. My name is George Benaroya. I worked at Procter & Gamble, Tetra Pak, Nivea, and now private equity as Vice President of Finance, Global Controller, and CFO. This material is from the graduate class I teach at NYU. This is one of 3 videos. We will cover how to read any balance sheet and how to use it to make business decisions. First, what is a balance sheet? A balance sheet is a statement summarizing what we own, called assets, what we owe to others, called liabilities, and what we invested, our capital or equity. We get assets by borrowing from others or investing our own capital. Thus, assets equals liabilities plus equity. Let's look at one example, Apple's P&L. We see their assets, their liabilities, and their equity. Why would you want to use a balance sheet? To ruin your weekend counting inventory? Isn't it boring to be doing all that? We'll see how to make the use of a balance sheet simple, useful, and fun. A balance sheet will enable us to sell more units at a higher price with a lower cost. This is because we will know how many units to have in stock, whether to sell on cash or credit, and how to finance our operations. How to read any balance sheet. The 5 main business drivers. Most balance sheets will have 30 or more lines. There are only 5 drivers we want to focus on. I'll show in red the ones that use cash and in green the ones that provide cash. First, receivables. Second, inventory. Third, property, plant, and equipment. Fourth, payables. And fifth, debt. Like for the P&L, other companies will use different terms. Property, plant, and equipment, for example, may also be called fixed assets. Let's see now how to read any balance sheet. Example number 1, Apple's. Uses of cash. First, receivables. Second, inventory. Third, property, plant, and equipment. And sources of cash. Payables, and debt. Is there a way to compare these dollar amounts that is easier? Yes, like for the P&L, we'll use percentage of sales. Receivables, inventory. 1% is a low ratio, is 3 to 12 or 15 days. We could get to this number by having our suppliers hold inventory and deliver to us just in time. Property, plant, and equipment, and payables. Payables at 21% is higher than the sum of receivables and inventory at 11%. What this is saying is that first we sell and collect from our clients or consumers, and then we pay our suppliers. And debt. Example number 2, this is balance sheet. Uses of cash, receivables, inventory, property, plant, and equipment. And sources of cash, payables, and debt. Now, as a percentage of sales, receivables, inventory, property, plant, and equipment. 50% is a very high ratio. This makes sense because in the case of Disney, they own both the parks and the studios. Payables and debt. Example number 3, Estee Lauder's balance sheet. Uses of cash. First, receivables. Second, inventory. Third, property, plant, and equipment. Sources of cash. Payables and debt. Now as a percentage of sales, receivables, inventory. 14% is the highest we have seen. One could argue that this may be driven by the number of SKUs or different products one has. Property, plant and equipment, payables, and debt. Let's now see how to make our own balance sheet using Jenny's example from our P&L video. Jenny is a student and runs a high-end shoe business on the side. She buys high-quality, made-to-order shoes from a friend for $300 and sells them for $1,000. Once per month, Jenny flies to China, buys the shoes, brings them back, and sells them at her apartment in New York City. Let's look at the transactions day by day. On Mondays, after her finance class, Jenny goes to the airport and gets a ticket on Emirates to China. These are the transactions. When she buys the ticket, her payables increase to $4,300. On the other hand, she has the right to travel, what we see on the left-hand side on her P&L, which are her expenses. On Wednesday, when Jenny is in China, she buys the shoes from her friend at this store. 10 pairs at $300 each. These are the transactions. When she buys the shoes, her inventory increases to $3,000. Before, when she bought the ticket, her payables were $4,300. Now, with the inventory, it increases to $7,300. Jenny flies back on Fridays, and on Saturday, at her apartment, she sells all the shoes. These are the transactions. 10 pairs at $1,000 each. She gets cash for $10,000. Her inventory goes down from $3,000 to $0 because she doesn't have any more shoes, and she still owes $7,300. Have you noticed this T symbol that we've been using in the background? This is a double entry accounting system, and it's supposed to match the left-hand side with the right-hand side. If we think about it, how did Jenny get $10,000 in cash? Where's the difference of $2,700? Did she borrow the money? Did she invest her own capital? No. The difference is because she sold for $10,000 something which costs $7,300. That's her net income, and now both sides match. On Sunday, when she wakes up, Jenny remembers that she has $10,000 in cash and that she owes $7,300. So she goes to the bank and pays her Visa card and to her friend. Her cash is reduced from $10,000 to $2,700, and her payables are now diminished from $7,300 to $0. She doesn't owe any more money. To recap, we have learned the process to analyze any balance sheet from any company or industry. We have also learned how to make our own balance sheet and how the business decisions we make affect our cash flow. On the next video, we will learn how to help Jenny improve her cash flow for a Christmas sale.